Hi, Richard.
Hey, Bob.
How you doing?
I'm well, thanks. And you?
I can't complain. And I'm very happy that you're with us to explain the latest financial calamity. This is when you get an email from me when there's financial trouble brewing. You were with us when the pandemic started and the financial collapse began to walk us through that. Let me introduce both of us. I'm Robert Wright, publisher of the Nonzero newsletter. This is the Nonzero podcast. You're Richard Vague. The thing you've done most recently that's relevant to the conversation we're about to have is you've written a piece for the Journal of Democracy called "The SVB Failure: Why It Happened and What It Means," where SVB stands for Silicon Valley Bank. I want to talk about all that, talk about where we stand in this thing, whether whether we should be worried, and so on. Let me talk about your various relevant credentials. I mean, first of all, you've written some books. The Next Economic Disaster is one we discussed on this podcast. A Brief History of Doom, The Case for a Debt Jubilee, and also nice coffee table book. If people need a gift for the capitalist in their life, called An Illustrated Business History of the United States. Lots of illustrations and graphs and so on. You also have a lot of vocational experience that's relevant to this conversation. You've been president of or CEO of First USA Bank and Juniper Financial. You're also venture capitalist, and of course, SVB served venture capitalists. And you were Secretary of Banking and Securities for Pennsylvania. Now, does that mean you were the rough equivalent of the California authorities who stepped in and closed down Silicon Valley Bank a couple of weeks ago?
That's exactly right.
So this was your job, to spot trouble and close banks.
Up until January.
Up until January. Did you have to close any banks?
We did not.
Well,
we kept an eye on a few, though.
How close did you come? Did you have to pick up the phone and say maybe you should liquidate a few assets or anything like that?
You know, the folks that I had the privilege of managing as supervisor or secretary of banking were superb, and we're all over this. So California should be so fortunate.
Oh, okay. Well, so before we get into kind of exactly what happened, whether there were regulatory failures, what improvements maybe should be made in the regulatory structure, should we be worried that this thing isn't quite over? I mean, the Wall Street Journal hasn't quit featuring like 3 consecutive pieces on the homepage that are relevant to this. I noticed. I'll relax as soon as you see a story about something wholly different as the lead piece in the Wall Street Journal. In the piece you wrote for Democracy, Journal of Ideas, you sounded pretty calm. Yeah, you thought, and this was written about a week ago, I guess, but at that point you didn't imagine a lot of contagion, seemed to be under control.
Yeah, well, what we said in the article we'll see continued failure, perhaps, of a few small banks or smaller banks, and that we'll see something happen with Credit Suisse. Sure enough, something happened with Credit Suisse. There'll be continued reverberations, but what I really want to contrast it to is 2008. We're not going to see anything of near that magnitude. This increases the chances of a recession, of what I would consider to be, if it happens, an ordinary recession. But your interest rates are still high. The Fed isn't reducing interest rates. So any bank that was experiencing stress in their bond portfolio is still experiencing stress in their bond portfolio. The regulators need to remain alert. I assume there won't be much else, but there'll be a few other things, I would guess.
Mm-hmm. And the Fed is going to make a decision like what, today or tomorrow or something? Is there news coming out this week about whether they will raise rates? The expectation was that they would have raised them had this not happened, and now it's not so clear, right?
Well, keep it in perspective. The Fed has raised rates a scorching 450 basis points. And, for anybody who, wasn't paying attention, that's
Is that
an
like
enormous
4.5%?
level of increase. Pardon?
I said, is that basically a 4.5 point, 4.5% increase?
4.5% from 0 to 4.5% in the Fed funds market. So that's an enormous increase. And contrast that to the Volcker era when we had only half as much debt in the United States as a percent of GDP. In my opinion, that means a 450 basis point increase today has the impact of a 7 or 8 or 900 basis point increase did in 1980. It has that much additional braking power. And I say braking, intending both meanings of the term, braking in terms of decelerating and braking in terms of what we saw at SVB. So, all this kind of nonchalant talk about, the Fed could raise rates another half point because of the demon inflation and maybe only a quarter point, just masks the magnitude of what's occurred and, the stress that it's created on the system. So, I think the current wisdom is that they'll only raise a quarter of a point this week, but I would suggest the phrase "only" continues to be somewhat ironic in the context of everything that's occurred over the last few months.
Okay, so they're really pulling out kind of the big weapons already to fight inflation. In your view, the Fed has already gone pretty far. You mentioned debt to GDP ratio. Let's go on a very brief tangent here because you've done a lot of work on the question of what leads to huge financial problems, like the Great Depression and so on, and economic collapse. And in your view, a key variable, if not the key variable, is debt to GDP ratio. And you note that this has been growing for some time. It sounds like, I don't know, I assume it's grown since the last time we talked. And one thing I wondered is how concerned you are on that front, whether the overall debt burden, and we should emphasize, you mean both private debt and government debt, not just government debt. In fact, private debt is most of the story. I was wondering how worried you are about that, and whether this kind of thing could feed into that. Could a contagion of kind of banking panic trigger the apocalypse that you think a high debt to GDP ratio is kind of courting to begin with? Does that make sense?
I do. I do sort of view them as separate things that can be coincident and therefore make things a lot worse. In this case, debt ratio, and by debt ratio, you're right. I mean both government and debt, but what I primarily mean is private sector debt. The government more or less can't default on its debt, except in the technical sense of like a debt ceiling or something like that quickly gets resolved. But the government can always fund its debt. It's what the power of the Federal Reserve and in a sovereign monetary system. But it's private sector debt. So the Great Depression was a runaway real estate lending and utility roll-up lending, believe it or not. We know it was runaway mortgage lending in the 2000s. In Japan, it was runaway commercial real estate lending in the late 1980s. It's been fairly benign over the last decade. We haven't seen a big run up. There's little pockets of concern, one of them being tech, that we've mentioned a few times over the last year. And, a big part of that is what, SVB was doing. We see a little private equity concern, but those are small slices of the U.S. debt markets and the U.S. economy. So it doesn't give us general credit concerns, nor do I think this exacerbates that. If anything, what's going to happen now is that banks are probably going to become more conservative in their lending for a while.
Mm-hmm.
And so the likelihood of kind of runaway lending in any particular sector is decreased.
Okay. So let's talk a little about what happened. Tell me if I've got this more or less right. So, banks, they take our money, they tell us it's safe, but it's not actually there in the bank like as if the bank were a vault. They actually go do things with the money. They invest it, and there are rules about how much they have to keep there in purely liquid form in cash, but most of it goes elsewhere, which is fine so long as a whole bunch of customers don't come back and demand their money at once. But once concerns about a bank start growing, and word spreads that maybe the bank is in trouble, a bunch of customers might come and demand and start withdrawing money. That happened in the case of Silicon Valley Bank. And that was a bank because it served a bunch of companies, a bunch of small startups and other companies. A whole lot of them had deposits well in excess of the $250,000 insured federal limit. That's why they panicked. And then the other half of the story is that the bank had gotten into trouble because in taking money and investing it, it had invested in these, I guess, mid to long term, anyway, longer than short term bonds. I guess mainly treasury bonds. But then after they did that, interest rates went up. So that's not a problem as long as they don't have to liquidate the bonds, because they'll still get the money that the bond guarantees over the course of the lifetime of the bond. But if a bunch of people start withdrawing money, then they do have to liquidate the bonds, and the short-term value of the bonds, in the event that you have to liquidate them, had actually dropped because interest rates had risen. So nobody wanted to buy these low interest rates bonds anymore. They're and so that's kind of the essence of the problem they faced. Is that right?
Yes, you've captured it very, very well. What I would start by saying is that banks are inherently highly leveraged. People don't generally think about this, but this is good times, bad times, you name it. Banks are leveraged at kind of a minimum of 10 to 1, which means 10 times more debt than capital. And in some cases, that can grow to 20 or 30 to 1. Your average commercial lender wouldn't lend to a business that had leverage of more than like 2 to 1 or 1.5 to 1 or 3 to 1. Banks as an industry are inherently highly leveraged, which means you have to manage them very carefully because risk can throw them off kilter very, very easily. And that's why we have such frequent banking issues. In this case, Silicon Valley Bank kind of broke one of the 2 or 3 cardinal rules of banking. And that rule is don't invest short-term assets in long-term, short-term funding in long-term assets. Mm-hmm. So they took, demand deposits, which have a maturity of 0, and they were putting in what we presume was about an average 10-year bond. Mm-hmm. And so what you say happened, their $21 billion bond portfolio that was, called available for sale, meaning they were free to buy and sell it as a trading asset, declined from 21 billion to about 19 billion. So that was a $2 billion or $1.8 billion loss. Well, that was kind of
real money.
That took them under regulatory capital minimums. But that's a violation of a cardinal rule. I mean, this is banking 101. You're supposed to invest short-term funding in short-term assets, 30-day, 90-day. Sorry, go ahead.
Okay, yeah, well, let me ask you a question. I was wondering about this. Has that always been the expectation? Because I was thinking about the movie It's a Wonderful Life, right? Where there's about to be there's a bank run in progress. Jimmy Stewart shows up and calms everybody down, and he says, "Hey, Bill, the money you deposited in the bank, that's in Harry's house, because Harry got the mortgage. And that's in Sam's hardware store, because that's the loan that and those were not, I would assume those were not highly liquid assets, right? I mean, now, of course, mortgages are bundled and sold as if they were like, candy bars or something. But in those, wasn't it at one point the case that actually the investments were long term, and so a bank run could be fatal? I mean, if banks did what you're recommending and all the investments were just completely liquid, there couldn't be a bank run, right? Because the money you could always deliver 100% of the deposits if you really had to. Does that make sense?
Well, let's talk about that, because banks are supposed to manage their assets and liabilities to be matched. And if you have a long-term asset like a mortgage, you're supposed to secure long-term funding. The average mortgage has a 7-year maturity, so you should get 7-year funding. Let's come back to that point. But you're supposed to keep reports. The regulators are supposed to examine those reports. They're supposed to audit those reports. You're supposed to stress test that scenario. And if there's a mismatch, you're supposed to resolve it. So that's a cardinal rule. Banking, if you go back to the early 1700s in Scotland and carry it forward, has always been about, the early banks in the US, the average loan was 90 days. So the mortgage, and banks didn't make real estate loans. In fact, in the 1920s, banks' average real estate mortgage loan was 5 years in maturity. There weren't 30-year mortgages. And the savings and loan industry that Jimmy Stewart, exemplified, and It's a Wonderful Life, was an aberration for the very reason you suggest. And it was always a mismatch. And we saw what happened in the 1980s to the savings and loan industry. It almost failed en masse as a result of that. And today, banks appropriately don't carry mortgages on their balance sheet, by and large, for the very reason you say, and by the very method you suggest. That's why securitization came about, was a way to restore asset and liability matching for a bank. So, no, it's a cardinal rule, and it's a cardinal rule that should be followed, and it wasn't followed, and a bank failed here.
Does that mean there was a regulatory failure, an oversight failure?
Well, we're hearing a couple of things. What I said in the article I wrote was, I want to give the regulators the benefit of the doubt, but that the regulatory apparatus is really not oriented to intervening too soon. We've studied in our book, Brief History of Doom. We look at 43 major banking crises over 6 countries over 200 years. So we have a little bit of a database. But in the 1980s, Edwin Gray tried to intervene, against the savings and loan industry, and a group of 6 senators, famously intervened to have him removed and put a more compliant regulator in. It's just, the whole apparatus just doesn't work that way. Regulators, in my view, are better and more oriented to intervening after the trouble has begun. And I would actually argue that's something that we need to rethink.
So, in theory, I mean, if you've got your house in order, if you're a banker and you're doing things right, you should, every dollar that is just a deposit, that is just like a checking deposit, and people expect that they can go in and ask for all of it and get it, every dollar like that should be matched by an asset that is extremely liquid, and is worth $1. And if for any reason that changes, you should do something right away. I mean, you probably can't reduce the amount of deposits in the bank, but you need to raise capital. Right? I mean, that's the way banks are supposed to run. So no bank run well should have been in this position to begin with.
Yeah, in my banking career, which I was in banking for over 30 years, we would meet on this weekly. We had extended meetings weekly in which we tested asset liability scenarios. There's one more scenario beyond what you suggest, and that is this idea of liquidity, that I should have actually excess liquidity our policy at First USA, as one example, was we carried so much excess liquidity that if the world fell apart and we had no access to anything for 6 months, we'd still be fine.
Hmm.
Most of the world doesn't do that. We did it. We think the most conservative banks do. The reason they don't do it is it's expensive.
Right.
It's like buying an expensive insurance policy.
Mm-hmm.
It's more profitable to run in a riskier way than we ran, and then clearly that SVB ran.
Yeah. So David Sachs, whom I think maybe you mentioned in your piece, because he's a VC in Silicon Valley, and he was involved in kind of on social media trying to get the regulators' attention, get them to do something dramatic over the weekend, which they did. But he's floated this idea that, so I guess, first of all, he's saying there should be banks where businesses can deposit a large amount of money, which they kind of need to do. I mean, it's a separate question whether they really need to or whether they could actually avoid having this situation where their deposits are so in excess of the $250,000 insured limit. But anyway, certainly easier for them if they can put a ton of money in a bank. And I think he's saying that there should be banks where that can happen, but if you're going to make sure the money is safe, they should change the required accounting system to so-called mark to market. In other words, fine, go ahead and invest in your long-term bonds, but you have to keep updating the value you attribute to those assets according to what you would get for them if you had to liquidate them today. So if the value of the asset drops because the interest rates rise, then your books have to reflect that. Suddenly you've got fewer assets and you need to deal with that. Raise more capital, do something, but you got to keep your books in balance. Does that sound like, do I have that proposal right? I'm sure you've heard things like it.
No, there could be more robust reporting there, but there was already sufficient reporting where that was known. Anybody with a basic understanding of financial reports would have known that, a month before, a quarter before, a year before. There was enough information.
The regulators read the Wall Street Journal. They could have told you that these assets had dropped in value.
Well, and reportedly the regulators had been in there. I mean, we'll know one way or the other, I think, over time, but the little stories that are leaking out, the regulators had been in for, a year or more in very pointed discussions about this very thing. They had BlackRock come in and do an audit of their risk management processes and had found that they were deficient in 11 out of 11 risk management processes. This was well known and well understood. So, we could do a little bit more reporting, a little bit more clearly. And the other thing that I would say is corporations are supposed to do some risk management themselves. In any company I've been in and in any bank I've been in, we had a risk management policy regarding where we put our assets. And clearly, not many, if any, of these companies that were depositors at SVB had an internal risk management process themselves. And by the way, risk management is not that hard. Diversify your assets. That might ring a bell. Don't put all your eggs in one basket. These are risk management 101 type concepts. And it should be a written policy. It should be audited monthly or quarterly. Your risk assessment of your counterparties, which is what these are called, should occur frequently. We're only 15 years away from the great financial crisis and only 2 years away from the pandemic. How is it these folks didn't have a risk manager?
They didn't even, you mean there's an official they should have, an executive they should have had that they didn't have? They didn't.
Abso-freaking-lutely.
Really? So there's like a person, there's a job that responsible banks have.
Excuse me.
Yeah.
excuse me, any operating business of any type, even if it's the local hot dog stand, should do a lot of thinking and planning around risk management.
And
That's just
it's standard
please go
practice.
ahead.
It's more or less standard practice at banks, and SVB just didn't do it. They just didn't have a person who
Well, I'm
fits
not
that
talking
description.
about, who knows? I mean, I hear that their software didn't properly calculate the value of the bonds, but they probably at some point in time, started to have these kind of
Yeah.
things. But I guess there's two things about a risk manager. One is that you should have one, and secondly, they should know what they're doing, and thirdly, I guess they should have the authority to
Yeah.
attack. But I'm not just talking about the bank. I'm talking about the businesses that deposited at the bank.
Yeah, let's talk about that because I mean, first of all, I mean, they should be aware that only $250,000 is secure in the sense of being insured by the federal government. And it seems to me there are ways to, I understand they got to meet payrolls, but a lot of these are startups. It's not like every 2 weeks they're paying out a whole lot more than 250,000 in payroll. I mean, it seems to me in principle that if they have their money in 2 or 3 banks and then they make regular transfers from some money market fund or something, they should be able to avoid having the massive exposure that apparently they had. They had millions and millions, tens of millions of dollars of uninsured money sitting in a bank. Some of them, I gather, and that's kind of crazy, right? And avoidable.
It sounds like you yourself could serve as risk manager for one of these institutions.
I'm available. It pays better than what I'm doing.
The answer is of course. And I've been amazed and appalled at the number of folks that I've talked to, reasonably sophisticated business people I've talked to since 2 Fridays ago, that weren't even aware of the FDIC insurance limit.
Wow.
These are basic things, and may I say, the conclusion of my article is basically all businesses forget. I mean, I'm overstating what I wrote, but more or less, most businesses forget most of the things they know about risk management fairly quickly. And it's not just. I'll give you another one. Putting all your money in one bank is risky. Buying all your supplies from one supplier is an equivalent risk. Anybody that's getting all their manufacturing done in China wasn't thinking about risk management. In that case, supply chain risk management. So risk management really impacts every aspect of every business.
Mm-hmm. Yeah, and I wonder how much of this, I mean, as you say, it's not uncommon for businesses to lose sight of risk, but I wonder how much of this has to do with kind of the spirit of Silicon Valley in a way. I mean, let me put it this way. As as a VC, that the standard VC model, I think, especially in Silicon Valley, is, you're going to invest in 10 companies. You fully expect most of them to fail. It's just that you're investing in the kinds of businesses where if the business clicks, it's going to make, huge returns because it's in some kind of business where there are network externalities or whatever. That's kind of the Silicon Valley model. And that means you're investing in a bunch of largely young entrepreneurs who themselves are probably pretty risk averse because whether they realize it or not, they're probably going to fail. They're going for the brass ring and they're probably going to fail. So they're these ambitious, hard-charging people probably don't think a lot about risk. Isn't it the job of the VC, once they've invested in a company, maybe they have a seat on the board, to pull these 24-year-olds aside and say, listen, let me explain to you what the FDIC is. How much of your money in this bank is actually insured? I mean, wasn't there a failure there?
Yeah, I mean, you're starting to get, 1 or 2 layers removed. I mean, we know very successful VCs that are very hands-on with their companies, and we know equally successful VCs that are completely hands-off with their companies. So, I think the company, I would put most of the burden on the companies themselves, but there's some truth to what you say.
And do you think SVB itself got swept up in the spirit of Silicon Valley, the kind of devil may care, attitude that could lead you to pay insufficient attention to risk? This is surely conjectural. I guess I'm asking you to be some kind of cultural commentator or something, but.
Yeah, but again, I would say we've studied the 43 biggest financial crises in history over the last 200 years in the largest 6 countries. And, we can point to every combination of circumstances, but the common denominator is they just stopped paying much attention to risk and had some element of hubris or whatever that, caused them to not take as much risk as serious as they might. Certainly what you say is true. There's lots of other sets of circumstances that end up at the same result. I would go so far as to say it's endemic to human nature to discount risk.
Yeah, I would say that too. People differ greatly. It's amazing how much variation there is among people actually in their kind of natural aversion to risk. But I think often you wind up with relatively risk-averse people running organizations for whatever reason. Or not whatever I meant, not so risk-averse people. Perhaps especially in Silicon Valley. But should people? So there's an argument over whether you should call this a bailout, a backstop. Whether people should be outraged. One line, of course, is that Silicon Valley has no few libertarian-oriented people who are generally not fans of the government, spending a lot of money to help people through their troubles. And suddenly they want the government to step in a big way and make sure that their money is safe. There's that whole complaint, and the complaint that this is a bailout. How do you think we should think about the government's performance here? The government has said taxpayers aren't going to be on the hook for this, but somebody, the cost is going to be diffused somewhere, and somebody's going to have to pick it up, probably to the extent there is cost. What's your take on the way we should think about this and whether we should be indignant?
Well, the strange way the world works is that we need these reminders from time to time. Folks forget the lessons, and there has to be something, catastrophic or semi-catastrophic or at least painful happen to remind folks and refocus on this thing. Just, we look at the entire, 250-year history of the United States financial markets, and I keep trying to find, a nice little 20-year slice of history where there isn't, some calamity. Well, it just doesn't exist. Once you dig into it, there's more calamities and disruptions than we remember. So, the other thing that I would suggest is, folks, imagine this past where business in the United States was laissez-faire and government and business were separate. Well, no such period in American history exists. The government was deeply involved in business from all the way back to the days of the American Revolution, when folks were training manufacturers and financing manufacturers to build weapons and bullets, and stealing intellectual property from, Tench Cox and his guys that stole intellectual property from Britain to start, an industrial revolution here in the United States. And it was government that financed the Erie Canal, and it was, government that financed much of the massive railroad. There's no such thing as a period where business and government weren't deeply intertwined. They're interdependent, if not codependent. So, yes, business should have done better here, and yes, it's clear the government could have intervened and didn't. So I would suggest that it's an important reminder that ought to cause us to rethink risk management from both directions.
And, people talk about moral hazard, right? Like the trouble with stepping in and saving everyone is that then they won't learn the painful lesson and they will repeat it. Now, in this case, the shareholders in the bank did learn their lesson. They lost their money, right? And that's good, I guess, because it was the bank fundamentally that was failing to tend to its risk management. But as we've also said, the depositors, which were Silicon Valley companies by and large, were not doing their due diligence and thinking through risk, and they're basically getting off scot-free because the government decided to step in, and we should be clear about this, and exceed their legal responsibility to insure up to 250,000. In effect, they decided, actually, we're insuring an infinite amount of deposits. Your money is safe. And they stepped in. And again, taxpayers aren't going to be on the hook for this. I think they're going to pay for it via some kind of the banking industry is going to be taxed, but that does mean that somebody's going to pay. Banking customers are going to pay some amount or something. So anyway, some people argue, well, that's a moral hazard problem. If these Silicon Valley companies don't have to pay any price for their negligence. But do you think that, look, we basically had to do this to stop what could have been a much wider contagion?
Yeah, it's a kind of a lesser of two evils scenario. But let me step back for a moment and say the United States had many banking crises before FDIC insurance ever existed. We had major banking crises in 1796, 1819, 1837, 1857, 1873, 1884, 1893, 1907, 1914, 1921. We had plenty of these where depositors lost their money and could have or should have known not to have their deposits in a trouble bank. So, the moral hazard argument isn't airtight. But yeah, there's a little of that there. But as you suggested, there were folks that suffered the consequences, management of the bank, the shareholders of the bank. In the case of Credit Suisse, some of the bondholders, have learned that, this, cocoa bond or this kind of fake equity bond got wiped out. And so there's some, but if we're down to that last piece, which is depositors over 250,000, you have zero time to make a decision. And it's a lesser of two bad choices kind of a decision. Lots of little people can get hurt over here, or we save some people that don't deserve to be saved over here. Take your pick.
You mentioned all these past crises. One thing I didn't realize until I read your piece is that the FDIC was originally we now think of it as this kind of inflation manager, via interest rate management, but it was created to be a lender of last resort and so that it could do things like stop bank panics. And before that, apparently the big banks like JP Morgan just kind of took it upon itself to be the lender of last resort to head off panics. It's funny, I saw a tweet from whatever that guy's name is, who famously, he does, what is it? Is it one of those shows on the financial cable network? You know him, he's super famous. But he tweeted, JP Morgan is a fortress. And now I'm starting to think that must have been a quote that was pulled from the distant past, and it was a little joke on his part. Because now, JP Morgan is one of the big four banks. And now the idea is that is the fortress, that if worse came to worse and panic swept all the small banks, the four big banks would be left standing, and through some kind of, government orchestrated rejiggering, they would absorb the liabilities, blah, blah, blah. But I guess, in that sense, maybe things haven't changed so much. We do have to rely on the big banks ultimately to be willing to.
I'm not sure I buy that. And big banks are like to portray them would love the fact that you said that, because, in 2008, they were in the exact opposite role. They were had to be rescued and the government had to save them. Big banks aren't big enough by any stretch of the imagination to handle a real panic. And that's the issue. The Federal Reserve is. And, it all started, back, England was having its crises, with the modern banking industry didn't really come about until late 1700s and early 1800s. And the Bank of England had been created in 1694 and kind of evolved into the role that Walter Bagehot, who was the editor of the Economist, described as this lender of last resort role. It could come in those days by supplying gold, by the way, as the last line of defense. And we didn't have one. We never had a central bank, until 1913. And it was because of the crisis of 1893, which was massive, and the one in 1907, which was almost as massive. And in both cases, J.P. Morgan personally, not just his bank, he called the meetings and got the bankers in a room and says, you do this and you do this. And, that's kind of an uncomfortable position to have to depend on the ad hoc, accumulation of enough banks to intervene in a case like that. And so that's what was the impetus for the movement that resulted a few years later in the creation of the Federal Reserve. It was supposed to be the guy that could step in and stop everything. In fact, the first chairman of the Fed said, we'll never have another banking panic as a result of the fact that we now have the Federal Reserve Bank. And, of course, that wasn't the case, because in 29, even the Fed, didn't step up to do exactly what it had been created to do. And we had the Great Depression. For a real crisis, this is not a crisis equivalent to 2008. So it may, in this case, J.P. Morgan is trying to save a relatively small bank here in the Philly area called First Republic, and is having to scramble to even make that happen.
The First Republic's in Philadelphia. I didn't know that, because that is the big Wall Street Journal story now. What's going to happen with that? So if you were still in office, you would be you wouldn't have time to talk to me. You'd be dealing with that if you were still the Secretary of Banking and Securities there in Pennsylvania, right? I mean, this would be occupying your time.
Probably would. And but that I guess the point I'm trying to make is banks like J.P. Morgan are stepping in to try to resolve that situation, and it's taking a massive effort on the part of J.P. Morgan and the other lenders there. So they couldn't step in if we had anything going on at the level of 2008.
Okay, last question on this subject before we move on to something else is so these smaller banks had successfully lobbied, I mean, including SVB, to be liberated from some of the requirements associated with Dodd-Frank, and I gather, and so they were under less, in some sense, regulatory scrutiny than they might have been a few years ago. Did that? I mean, how outraged should we be? No, I guess that's not quite the question. Question is, did that really contribute to this? And should that be reversed? I mean, and in general, what kind of new, if any, regulatory legislation should there be?
It took away a little bit of the oversight of things like, asset liability and liquidity management. But the regulators still had the powers they needed to do something. Perhaps it wasn't as prescriptive. It would have more relied on the judgment of the regulators rather than the formula of legislation. But let's be clear, the regulators had plenty of tools to deal with this. I do think we ought to be thoughtful and look at the minimum, which was raised from 50 billion to 250 billion. But there was plenty for the regulatory community to rely on to intervene.
Okay. All right. So we have reached the end of the public part of the podcast. You and I are going to keep talking a little and change the subject a little. I want to hear more about your history as a successful entrepreneur. I want to talk a little about a hobby horse of mine, which is the value of cognitive empathy or perspective taking in the realm of business, for example. And if anybody wants to listen to that, they can subscribe to the Nonzero newsletter, become a paid subscriber. And then they'll have access to that. You can actually do that in the show notes on your smartphone to this podcast. There's a link to the Substack site where you can subscribe. You can also, if you don't feel compelled to listen to the rest of this, become an unpaid subscriber. You get stuff that way too. But in any event, thanks everybody who's listened this far, and thanks Richard for taking the time. Before you and I continue the conversation, anything else you want to say about your work? We've mentioned some of your books, but if any of them are particularly relevant or anything you're doing online that you want people to be aware of?
Well, I have a new book coming out in July called The Paradox of Debt, which will be a new view of macroeconomics. So I'm very excited about that and hope folks find it of value.
Okay. Well, thank you. And now let's move into overtime.